Welcome to the first quarter Wespath webinar. My name is Joe Halwax, and I'm the Managing Director of Wespath's Institutional Investments team. Today I'm coming to you from our offices here in Glenview, Illinois. Thank you for joining us. This quarter saw the devastating invasion of Ukraine and resulting humanitarian crisis unfold. Our thoughts and prayers continue to be with the citizens of the Ukraine. And please note, the United Methodist Committee on Relief has options for donations at the link you see on this screen. While we've witnessed a great deal of human tragedy, we've also seen worldwide support. We've seen compassion and a willingness to help the millions of refugees and others who've suffered from this invasion. This serves as a reminder of the importance of mission-focused organizations and other nonprofits from around the world. They support those in need every single day. Today, I'm going to give a brief organizational update, cover our work in sustainable investments, update you on the markets, the performance of our funds, and close it out with an economic update from our Chief Investment Officer, Dave Zellner. First, I'd like to highlight some new thought leadership released this quarter. The first is an installment in our Fiduciary Focus series, focusing on investment complexity and operating models. The second is a blog from my colleague Karen Manczko, detailing some considerations for investors as they hire an OCIO provider. These articles and more are created to help educate our stakeholders and can be found on our website. I want to welcome Jake Barnett from our Sustainable Investment Stewardship team. Jake, can you tell us, what is the Wespath Sustainable Economy Framework and how does this drive your work?
Thanks for having me, Joe. So as a reminder, our Sustainable Economy Framework refers to our belief that in order to achieve return expectations of our participants and institutional investors, we need to see the transition to a sustainable global economy. We define a sustainable global economy as one that promotes social cohesion, long-term prosperity for all, and environmental health. In the next few slides, we'll talk about some examples of our work on each of these pillars.
So Jake, on everyone's mind is the Russian invasion of Ukraine. What are the implications for this with regard to the Sustainable Economy Framework?
So there are obvious implications for both social cohesion and long-term prosperity for all to the recent invasion. But before discussing the practical implications of the invasion, I also wanted to feature this quote from our CIO, Dave Zellner, speaking about how the act of aggression and unprovoked attack goes against the fundamental principles of the Methodist Church and our commitment to peace and prosperity. I encourage each of you to read his blog if you want to learn more about our position. In terms of next steps we have taken in relation to the conflict, the first step was to instruct our asset manager to restrict new purchase of Russian securities within our portfolio. While there is not a functional ability to divest at the current moment due to sanctions, we are also using our invest, engage, and avoid framework to understand and examine how we want to position our portfolio to the long-term risks exposed by this event. This includes exploring engagement with companies and asset managers. Finally, we are exploring further collaboration on coordinated investor action with partners in civil society as well as other investors to encourage stronger adherence to international humanitarian law moving forward. Expect to hear more from us on that last front in days to come.
Thinking of the goal of long-term prosperity for all, can you talk about our positive social purpose lending program?
Always happy to talk about the PSP program, Joe. So we continue to invest in different affordable housing options through our positive social purpose lending program. And I'll share two examples today. The first is Abigail Apartments in Michigan, where we are helping to invest in senior housing associated with larger redevelopment that's innovative, located on the campus of the former Michigan School of the Blind. Second is Main Street Apartments in Wisconsin, where we have invested in affordable multifamily units. Now, 13 of those 64 units are actually earmarked for veterans or individuals with disabilities. The project will link residents with services to help them retain independence. These investments underline our belief that affordable housing is a fundamental pillar for support of long-term prosperity for all.
So Jake, Earth Day is April 22nd, the day after we release this webinar. Can you talk about how Wespath is supporting the Sustainable Economy Framework of environmental health?
So I'm going to take the liberty to cheat slightly, Joe, and tell you about two publications related to Wespath's leadership on net zero that are now live as of the release of this webinar. The first is a paper I recently co-authored with Patrick Para from Allianz as co-leads of the Net Zero Asset Owner Alliance engagement track. The paper is titled Future of Engagement and lays out the case that corporate engagement is a necessary but not sufficient tool for investors committed to net zero. It then goes on to argue that investors should complement corporate engagement efforts with the systemic tools of sector, policy, and asset manager engagement. The paper was covered in industry media, as well as receiving an exclusive from Bloomberg, and will help shape our focus on the sustainable economy framework stewardship moving forward. Wespath remains proud to be able to help contribute in meaningful ways to conversations about how to move global climate stewardship forward. The second announcement is more specific to the United Methodist Church and relates to the release of the inaugural progress report from the Net Zero Agency Coalition. As a reminder, this coalition is comprised of 12 of the UMC agencies who have collectively committed to achieving net zero in their facilities, operations, missions, and investments by 2050. As co-lead of this initiative, Wespath has helped put together the inaugural progress report. And to read more about what the coalition has done to date, please check out our website, UM News Service, or UMCom's new climate page dedicated to this initiative.
Thanks for the great work in the update, Jake.
Thanks, Joe.
Welcome to the market update for the first quarter. At our last update in January, we noted the high level of market uncertainties that would likely result in higher volatility than we experienced in 2021. Indeed, the start to 2022 has been very volatile, with three key themes: inflation, rising rates, and the conflict in Ukraine. While COVID has finally diminished in terms of a market driver, the hangover from COVID policies to support the economy is lingering and is in part responsible for the continued high levels of inflation we are seeing globally. To combat inflation, global central banks are raising rates sharply, and the U.S. started rate hikes last month. Most analysts thought a war in Ukraine was a very low probability. It is now looking like a once-in-a-generation event that will have an impact for years or even decades. In the short term, it has further hurt supply chains and is putting further upward pressure on energy prices. Longer term, the Ukraine war has further exacerbated deglobalization that we have seen pre- and post-COVID, and has further implications regarding energy security, defense spending, and a possible reorder of the global powers. For the past year, I've mentioned that it will be a relief to never show a COVID slide again. And at the risk of jinxing us all, this may be the last one. Looking at the chart on the left, you can see COVID numbers have collapsed in terms of new cases and deaths. On the right, we have a new chart of high-frequency economic data: credit card transactions, hotel occupancy, seated diners, and TSA traveler traffic. All four are above or near pre-COVID levels. And credit card transactions are sharply higher, very positive for growth, but also for continued inflation. Looking at equity returns on the quarter, they're negative, but note they're off their worst levels of the quarter by a significant amount. The S&P 500, for example, was down 4.6 on the quarter, but at its lowest was down about 13%. The Russell 2000 Small Cap Index closed down 7.5%, but was off 14% in both January and in March. Sharp losses early in the quarter were driven by continued and rising inflations, with further supply chain and energy concerns on the back of the war in Ukraine. The rising inflation expectations has prompted the Fed to become very hawkish, which I will cover shortly. Given Russia's position as a major energy exporter, prices rose sharply in Q1, along with uncertainty, especially after the Feb 24 invasion. When the fighting started, most expected a short and swift victory for Russia. But as the war rages on, the human toll rises, and there is a great deal of uncertainty around globalization or deglobalization, also energy security, and the global order between powers, which is looking more and more like another Cold War. Specifically, we may see a future with closer ties between Russia and China, while the NATO countries are unifying against this Russian aggression. Note the worst performing sector in equities was the mega-cap stocks at negative 12%, which is a continued underweight in the U.S. equity portfolio here at Wespath. Looking at the price-to-earning ratio in this chart seen on the left, The green shows that the top 10 stocks have a valuation at 30 times earnings versus the S&P index at 19.5 times. The weight of the top 10 stocks is just under 31%, the highest percent in 25 years. But looking at the earnings contribution at the bottom right, it's fallen sharply from 34% to 24%. This helps explain some of the underperformance of mega-cap stocks in Q1. For international, the MSCI index was down just under 6%, in line with the performance of the US. Note that the outlook for international has changed with the Ukraine invasion, with weaker growth expected in Europe, given the rise in energy prices and both their proximity to and dependency on Russia. However, other parts of the world look attractive, especially countries that have natural resources and are energy exporters, like several countries in Latin America or Norway. China continued to underperform, down 14% on the quarter. This on the back of the nation's regulatory campaign, concern about removal from US exchanges, and the zero COVID policy that is causing enormous work lockdowns in cities like Shanghai, which has 25 million people. While negative equity markets are never fun to report, we need to put this in perspective. In April, the S&P 500 was only off 5% from its all-time highs. This with inflation at 8.5% and a war in Ukraine. Looking at drawdowns over the last 40 years, the red dot shows the max drawdown for any year, and the gray bar is the full year return. You can see that in any given year, a 15 to 20% pullback is normal. And last year's 5% fall was historically very low. In 2022, we've already seen drawdowns near this 15% level. Before we look at fixed income, let's look at the US yield curve, with the yellow line showing 15 months ago, the orange line 3 months ago, and at the start of 2022, the blue line shows the curves as the end of Q1. It's quite evident that we've seen a dramatic shift in the level and the shape of the curve. It has risen across the board and by significant amounts in the short end, looking at the 1 and the 2 year sections, for example. The curve shifted higher and quickly as the markets priced in at least 8 rate hikes and an additional 200 basis points of hiking from the Fed this year. Again, let's remember just how quickly the sentiment changed. To start 2021, or 15 months ago, the futures market was pricing in the first rate hike in August of 2024. In September of 2021, so 8 months ago, there was less than 1 rate hike priced in for 2022. By December, there were a little more than 2 rate hikes priced in. By early March, there were 5 rate hikes priced in, but by the end of March, there were 9 rate hikes priced in over the next 15 months. Additionally, the Fed has signaled further tightening with balance sheet reduction at $95 billion per month. This is an extreme change in sentiment and expectations of tightening monetary expectations. Notice too that the yield curve is flattened. As the Fed hikes, we expect the economy to slow, and therefore the yield curve is flattened as you increase maturity. The sharp shift higher in the yield curve helps explain one of the worst bond quarters in my lifetime. Now turning to fixed income. It's rare to show a fixed income slide with this many negative numbers. In fact, this was the worst quarter for bonds in 40 years. The Bloomberg US Universal Index dropped 6.5% in Q1, with yields rising sharply as we just discussed. The US Treasury Index fell 5.6%, while the high yield sector fell 4.8%. Remember, the high yield sector is shorter in duration and also has the benefit of yield spread, which helps in a rising rate environment like we have now. The only positive number on this slide is the Bloomberg Commodity Index, up an eye-watering 25% on the quarter. This is the 4th highest quarterly rise in commodities since the index started in 1960. Of the top 10 quarters, most were in the 1970s. So this is a very difficult environment. Remember, the commodity index's largest component is energy at roughly 30%, and energy prices have risen sharply on the year. This, again, is part of the inflation theme that is one of the main drivers for 2022. In sum, there are now more headwinds than tailwinds for asset prices. There are positives, such as strong employment, earnings growth, still ample liquidity, and pent-up demand, especially for services. But investors are concerned about inflation, rising rates, and Ukraine. Importantly, there's a great deal of uncertainty around all three, and the further impact they can have on the global economy. Let's look at how the Wespath funds performed in the first quarter.
Thanks, Joe, and hello, everyone. The chart on the screen shows the net of all fee performance of the individual Wespath fund versus their respective market indices. The first row on the chart is the multiple asset fund, which is our flagship balanced portfolio. As a reminder, this fund has a 65% allocation equities, 35% allocation of fixed income. The funds directly below the multiple asset fund are the 4 core Wespath funds that comprise it. The first column on the chart showcases the first quarter net of all fee performance results. If you move your eyes to the bottom of the slide, you'll notice that the Inflation Protection Fund is the only fund that ended positively on an absolute basis in the first quarter.
So while we're on the topic of inflation, or the Inflation Protection Fund, Karen, let's switch things up this time and start by talking about our 2 bond funds.
Yeah, sounds good, Joe. So as you can see on the slide, the Fixed Income Fund and the Inflation Protection Fund both outperformed their respective benchmarks net of all fees in the first quarter. Despite being down 5.88%, the Fixed Income Fund outperformed its benchmark primarily because of the fund's diversifying strategies, such as our positive social purpose lending program and the fund's overweight to high-yield bonds. As I mentioned earlier, the Inflation Protection Fund was the only fund that ended the quarter in positive territory and also outperformed its benchmark net of all fees. And the reason for the positive performance in the fund is the fund's 10% allocation to commodities, which ended the quarter up 25%.
So Karen, how did our 2 equity funds fare in the first quarter, given the volatility of the markets that we have seen so far in 2022?
That's right, Joe. The markets have been quite volatile since the start of the year, which has been due to the impact of inflation concerns, Russia's invasion of Ukraine, and the Fed's more hawkish tilt. Focusing on the 2 equity funds, which are the first 2 funds listed below the multiple asset fund in the chart. As I mentioned, these funds comprise 65% of the multiple asset fund and were the primary driver of the quarter results, which was stock selection by our active managers. I'll highlight in a moment specific companies that impacted the performance. While the U.S. equity funds underweight to mega caps, which are the largest U.S. companies, had a positive impact on the fund, as those stocks were down 12% in the first quarter, this was offset by poor stock selection by our active managers and also the fund's overweight to small and mid-cap growth stocks. Poor stock selection by our external managers was also the main detractor for the international equity fund's quarter performance. But on a positive note, the 2 equity funds' allocation to private equity contributed to the fund's performance as we saw strong results posted from this asset class for the quarter.
Karen, we understand the recent short-term underperformance, but are there any comments on the longer-term performance?
Yeah, the reason for the 1-year underperformance for the multiple asset fund was primarily driven by the manager stock selection in our U.S. and international equity funds. Also, the U.S. equity funds underweight to mega caps, what detracted for the 1 year, despite being a contributor in the first quarter.
So I know we said in the last webinar that the 2-year perspective is helpful because of the volatility quarter on quarter. It's been quite high. And there's been significant changes in the stocks that outperformed benchmarks in 2020 to 2021 and now in 2022.
Yeah, absolutely. If we separate out the 2-year time frame, you can see that the funds have performed relatively in line with their benchmarks.
And how do we look relative to other balanced funds?
Yeah, the chart on the screen shows the multiple asset fund versus a universe of balanced funds. And the reason we show this is we want to see how the multiple asset fund performed relative to other balanced portfolios that are currently on the market. We're using a universe that is compiled and maintained by Investment Metrics, which is a well-known reporting provider in the investment industry. So as you can see by looking at the chart, the multiple asset fund performed below the median in the 1-year time horizon, but outperformed the median in the 3, 5, and 10-year time frame. So for instance, in the 10-year time horizon, the multiple asset fund outperformed over 64% of other balanced funds in this comparison.
Thanks, Karen. So moving on, why don't you tell us about the individual fund contributors and detractors for the first quarter performance?
Starting with our multiple asset fund, I highlighted this on the performance slide earlier, but the primary detractor to the fund's performance was the underperformance by our 2 equity funds, which I will specifically highlight here in a moment.
So you highlighted earlier that we saw some volatility in the first 3 months due to a few things that you noted. So how did this impact performance in our funds?
That's correct. We have seen some major market movements so far this year, which have been driven by inflation, rising rates, and the conflict in Ukraine. This has had a negative impact on equity and fixed income markets. Starting with the U.S. equity fund, this fund underperformed its benchmark by 34 basis points for the quarter. Mega cap and large cap growth stocks were one of the worst performing market sectors in the first quarter. Therefore, underweight to these stocks contributed to the performance. Also, our dedicated allocation to private equity and private real estate was a contributor. The primary detractor to the fund's underperformance was our overweight to small and mid-cap growth stocks. Growth stocks really struggled in the first quarter due to the negative impact the rise in rates have had on this asset class. Also, the fund's active manager stock selection in information technology, specifically e-commerce and cloud-based data management security companies like Okta and Snowflake, were down 33% in the first quarter, which had a negative impact on the fund's relative returns. Turning the attention to our international equity fund, similar to the U.S. equity fund, this fund's underperformance was primarily driven by stock selection of our active managers, specifically investments in e-commerce and biotech. A contributor to the fund's performance was the dedicated allocation to international private equity. Moving on to a question that we've been receiving from our clients is, what is the fund's allocation to Russia? In the International Equity Fund, it has been less than 0.5% prior to the onset of the war with Ukraine, and today it is less than that. I also want to mention that we have instructed our managers to not purchase any Russian securities in our portfolio.
Thanks, Karen. So moving on to fixed income performance, the equity market wasn't the only market that's seen some volatility, but we've also seen it in bonds.
Yes, the bond market traditionally has been seen as a safe haven for investors when the stock market is volatile, but this asset class has not been able to hide from the volatility we've experienced. The first quarter was the worst quarter for bonds in 40 years, and the main driver of the bond market performance has been the ongoing inflation concerns and also the Fed rate hikes, which the markets are pricing in 8 to 9 25 basis point hikes by the end of 2022. Despite the negative absolute returns by the fixed income fund, it outperformed its benchmark by 69 basis points gross of fees. There are a number of contributors that we've listed on the left hand of this slide, but the primary reason for the outperformance has been the fund's overweight allocation to our internally managed positive social purpose lending program, which provides affordable housing and community development in disadvantaged areas. Also, the fund's overweight to high-yield bonds positively contributed to the fund performance, along with issue selection by the fund's Core Plus and Global Bond managers. The only detractor to the fund performance was the allocation to emerging market debt, which was impacted by the increase in the U.S. dollar.
So moving on to our final fund, the Inflation Protection Fund. This is the only fund that entered the quarter in positive territory. So can you tell us how that happened given the negative performance across both fixed income and equities?
Yeah, the Inflation Protection Fund has really showcased its purpose, not only last year, but also this year, since inflation is a looming concern and will be for some time. As a reminder, this fund was created to protect investment portfolios against unanticipated inflation while providing a stream of income. It ended the quarter up over 1%, outperforming its benchmark by 81 basis points. The primary reason for the positive performance is the fund's 10% allocation to commodities. Energy, metals, and agriculture have continued to surge at a historic pace and ended the quarter up over 25%. Also, relative to the fund's custom benchmark, the fund is underweight UK inflation-linked bonds, and manager issue selection in the global inflation-linked bonds contributed to the fund performance. Despite the U.S. Treasury inflation-protected securities having better returns than other inflation protection asset classes, the fund's overweight allocation to this asset class detracted from the fund's performance since they couldn't keep pace with the fund's benchmark, which again includes a 10% allocation to commodities. Finally, similar to the fixed income fund, the fund's allocation to emerging market inflation-linked bonds detracted as we saw the U.S. dollar increase relative to other currencies, which also impacted this asset class. As I conclude my portion of the webinar, I think it's important to remind our viewers that the U.S. and the whole world has been confronted with another once-and-again lifetime event. We started 2022 with the Omicron variant lengthening the pandemic even more, and when that dissipated, we were confronted with Russia's invasion of Ukraine. All of this, with now historic levels of inflation and rising rates, have created even further uncertainty, and the markets hate uncertainty. Uncertainty can cause volatility, which can be difficult on investors because of the emotional aspect. and emotions around investing can influence bad decision making. Our goal at Wespath is to remove the emotion out of investing. We continue to remain invested and monitor our investment managers and their activities daily. We are here to work with our clients to ensure that we are continuing to invest on their behalf that allow them to meet their financial goals and support the mission of their organization.
Thanks for that performance update, Karen. So Dave, let's start with inflation. At the beginning of 2022, you listed inflation as your first risk for the markets. We're now 3 months into the year and inflation has continued to accelerate. What are your current thoughts on inflation and the trajectory of inflation, and when can we expect to see some relief on these high prices?
Yeah, so Joe, last week the Bureau of Labor Statistics reported that year-over-year inflation, as measured by the Consumer Price Index, was the highest in 41 years. It reported 8.5% year-over-year inflation. Now, our Federal Reserve aspires to maintain inflation at an average rate of 2%. Yet the market sees inflation averaging well over 3.5% for the next 5 years and averaging 2.5% over the next 30 years. So the graph on the right of the slide shows the dramatic increase in the market's 5-year inflation expectations. At the onset of the pandemic, investors thought inflation would be less than 0.25% for the ensuing 5 years. And now expectations are for greater than 3% inflation. This next chart shows the extent to which inflation has increased for necessities such as shelter, food, and medical care. We all frequently buy groceries, and we've certainly been experiencing sticker shock for meat, poultry, beef. Food inflation of nearly 9% is a very difficult pill for most of us to swallow. And the UN reported just the other day that higher food prices could be with us for a while due to the war in Ukraine. Now, I also think that higher rates of inflation for shelter are probably going to be with us for longer than many people might hope. Home prices are up, mortgage rates are up, the cost to heat and cool our homes are up, and all of this is compounded by a continuing housing shortage. Shelter inflation is just not likely to dissipate anytime soon. Now, the chart on the right displays the University of Michigan consumer expectations for inflation, which for the next year is about 5%, though I did see a survey just yesterday from the New York Federal Reserve that surveyed consumers who thought it would be closer to 6%. I have to say, Joe, it's been really interesting to read the vast number of mea culpas coming from those that just a year ago were in the transitory camp. I think we all could have predicted the inflation we are currently experiencing. I think the quote on this next chart sufficiently summarizes why we are seeing multi-generational highs in inflation. 3 economists from the Federal Reserve Bank of San Francisco stated, and I quote, "The sizable fiscal support measures aimed at counteracting the economic collapse due to COVID-19 could explain about 3 percentage points of the recent rise in inflation." Helicopters dropped a lot of money to a lot of people. And I certainly don't mean to imply that the fiscal support was unjustified. It's just the massive disruption to lives resulting from the pandemic required bold action. And we can't escape the fact that this bold action significantly altered the supply-demand balance that resulted in inflation. This next chart shows the extent to which we observed changes in consumer spending. In 2019, U.S. consumers collectively spent nearly $15 trillion. They spent 64% on services such as medical care, entertainment, travel, insurance, and spending in February of this year increased to an annual rate of nearly $17 trillion. but we're spending a larger percentage on goods rather than services. While 2.5% may not seem like that big of a shift, when applied to 17 trillion, it's huge. The left chart in this next slide shows the path of consumer spending adjusted for inflation over the past 10 years. While we certainly saw a big decline during the pandemic, current spending is back on trend with spending levels prior to the pandemic. But look at the right chart. Spending on services remains meaningfully below trend. And as you can see on the next slide, spending on durable goods such as cars, appliances, and non-durable goods such as food and clothing, they're way above trend. It takes time for the economy to adapt to changes in consumer preferences. And when combined with supply chain disruptions caused by the pandemic, one can understand that inflation was going to be inevitable. But the question you asked, Joe, was when will this all end? I do think that energy prices are nearing a peak, absent any further major geopolitical events. But I'm afraid that we have a while to go before we see a correction to the current supply-demand imbalance for durable and non-durable goods. We have some significant hurdles to overcome, including labor shortages and supply chain disruptions. And as mentioned earlier, I do think that higher housing costs will be with us for some time, and a prolonged war in Ukraine would likely contribute to increased food inflation. I clearly don't believe that inflation rates will continue at levels above 8% for much more than maybe a couple of months. But I think we have a long journey ahead of us before we again see pre-pandemic rates of inflation.
That's great. And Dave, as we know, the Federal Reserve, they have a dual mandate of promoting full employment and also fighting inflation. So with the unemployment rate rapidly approaching pre-pandemic lows, the Federal Reserve has signaled, and the market believes, that the Fed will significantly be raising interest rates in the remainder of 22 and into 2023. Further, given the inverted and flat yield curves that I mentioned earlier in the webinar, the market seems to be signaling that a recession is imminent. Should we be worrying about a recession anytime soon?
Yeah, that's a difficult question, Joe. And before I answer, I want to take a look at current projections for U.S. economic growth. So on this next slide, the chart on the left shows the Atlanta Federal Reserve's current forecast for first quarter GDP growth, which is at 1.1%. That compares to the consensus of forecasts by economists of 1.9%. And these are not numbers that's going to excite anybody. But remember, Joe, it was just 3 months ago in January that we were dealing with the largest spike of COVID infections resulting from the Omicron variant. Hence, the anemic first quarter growth shouldn't really be a surprise to anyone. But now look at the right chart. Every 3 months, the Wall Street Journal surveys dozens of economists for their economic projections. And the consensus now clearly sees slower growth rates for the full year, which they attribute to higher interest rates from stubbornly high rates of inflation that we just talked about. In the most recent survey that was released on April 10th, economists surveyed placed the probability of a recession over the next year at 28%, and that's up from 18% just 3 months ago. So now what do I think? Let's face it, Joe, recessions are a fact of life. We will always have recessions. We had a really bad recession, dubbed the Great Recession, 14 years ago. And then we had the longest period in U.S. history of no recession until the onset of the pandemic. So if I had to predict, I would fall on the side of no recession in the next 12 months. This next slide supports why I believe there won't be a recession over the next year. We currently have a really strong labor market. Unemployment rates are near generational lows, and unemployment claims are essentially at all-time lows. We still have 10 million jobs that employers haven't filled. there remains ample economic activity resulting from what I've called the Great Transformation, which has contributed to higher than normal demand for homes, autos, and other durable goods. All that said, there will come a day when conditions normalize, economic growth pauses, human resilience adapts, and then economic growth will resume. I'll conclude by saying that predicting the beginning and the end of recessions is extremely difficult. No one can consistently predict them. Hence, we at Wespath prudently adhere to a long-term strategy based on our investment beliefs, and we avoid timing the market based on economic forecasts.
So Dave, I want to shift gears to another item that you had identified as a risk to the markets for 2022, and that's geopolitical risk. Specifically, I want to ask you about the impact of the Russian invasion and war on Ukraine. Recently, two prominent investors, Larry Fink, CEO of the largest asset manager BlackRock, and Howard Marks, who leads Wespath asset manager Oaktree, and someone I know who you follow closely, they both made comments about globalization. Notably, several media outlets reported that they were warning investors about the end of globalization as an outcome of the Russian invasion and also the swift response by countries and companies to economically isolate Russia. If true, would this not run counter to a core Wespath investment belief regarding moderate and sustainable growth led by the developing world?
Yes, Joe, unfortunately, we need to discuss the likely impact of this brutal and tragic Russian invasion of Ukraine, as it definitely is a factor weighing in the minds of investors. We certainly grieve for those suffering in Ukraine and from the senseless Russian aggression. We can only hope for a miracle to bring this senseless war to an end so that the Ukrainian people can rebuild and carry on with their lives. Now, first, I don't believe we've seen the end of globalization. Second, I don't agree that the Russian invasion is solely or even primarily responsible for countries taking a step back and examining the extent to which they are willing to rely on sourcing commodities and finished products from other countries. As we discussed earlier, the shift in demand and supply chain pressures resulting from lockdowns and other disruptions have adversely affected economic growth around the world. The disruption to energy supplies and trade with Russia, Ukraine, and others has certainly exacerbated the problems of fulfilling consumer demand and further fueling inflation. So let's, for a second, Joe, just assume that globalization is at risk. If so, one might ask, what economies have more work to do to adapt to this disruption? This next chart displays the extent to which various markets derive revenue from internal sources domestically rather than from exports. As you can see, European companies source 45% of their revenue from other buyers in Europe. Accordingly, 55% of their revenue comes from outside of Europe. In contrast, emerging country companies source 2/3 of their revenue from domestic sources. Hence, the end of globalization, if that were to occur, is a greater threat to the developed world than it is to the developing world. That said, the U.S. and other parts of the developed world are undoubtedly working on plans to reduce their reliance on what they may temporarily consider to be unreliable supply chains. But as we discussed earlier, Joe, the U.S. is currently facing a significant worker shortage. If we're going to reduce our reliance on supplies sourced outside of the United States, the only viable solution is to accept a meaningful increase in immigrants. And I'm not sure that our country is ready for significantly higher levels of immigration. But even if we were, we simply don't have the housing stock to provide shelter for more people. So the short answer, Joe, is that it's a much more complicated issue than some might have us believe. And as you know, Wespath has this optimistic worldview about world economic growth. And yes, the pandemic and now geopolitical conflict has temporarily interfered with our view of the evolution of the world economic playbook. But we remain optimistic about humankind's resilience in its ability to overcome whatever obstacles it encounters. We will undoubtedly see near-term changes, but long-term, I truly believe that the global marketplace will continue to expand.
So finally, Dave, I want to pivot once again to China, which we discussed during our last webinar. You told us 3 months ago that Wespath remained committed to maintaining exposure to China. But once again, the Chinese markets have disappointed with declines of roughly 15% for the first quarter. We continue to hear about human rights issues, COVID lockdowns, tighter regulations, and provocative signals regarding its intention to absorb Taiwan. When do you think we can expect to see improved investment performance from Wespath's holdings of Chinese securities, and what's it going to take to right this ship?
So you're right, Joe. The recent performance of Chinese stocks has been disappointing, especially when you compare it to the U.S. stock market. We've seen excellent returns from U.S. stocks over the past 2 years. Through last Wednesday, April 13th, the S&P 500 was up a cumulative 43% since the end of 2019, yet the Chinese market has lost 16% during that same period. After gaining 28% in 2020, Chinese stocks fell 22% last year, and as you mentioned, are down roughly 15% this year. The fact is, Joe, Chinese stocks are not for the faint of heart. The chart on the left displays the performance of Chinese stocks over the last 20 years, and they clearly have been on a wild ride. If you were to ignore all the fluctuations, the average compounded rate of return for the Chinese market has been about 10.5%. Yet, peak to trough, we saw a 73% drop during the great financial crisis in 2008-2009, and this current decline we are experiencing is about 55%. We can take some comfort in knowing that the Chinese market appears pretty cheap based upon forward earnings projections, with the current projected price-earnings ratio near historical lows. As a comparison, the forward price-earnings ratio for U.S. stocks is more than twice that of the Chinese market. So why has the market taken such a dive? There are many factors that have raised concerns among investors. The first is China's management of COVID. We all know that China has a zero COVID policy and will lock down cities at any sign of an infection. Shanghai, a city with a staggering population of 25 million people, is currently in lockdown while we're filming this webinar. And I've heard you say, Joe, that you've seen videos of what's transpired during this lockdown that you wish you wouldn't have seen. Lockdowns in Shanghai and elsewhere have certainly interfered with economic growth, and there's a lot of uncertainty among the investment community as to how long these lockdowns will continue to occur. Let's take a look at this next chart that shows the history of COVID infections in China compared to the United States. As we know, the coronavirus originated in China at the beginning of 2020. Chinese authorities immediately implemented strict control measures which successfully arrested spread of the virus. So I want to encourage our viewers to look closely at these two charts and specifically at the scale of the y-axis. Even though you see a big spike of Chinese infections on the left chart recently, the number of cases is trivial compared to what we experienced in the US for any of our three waves. Despite the current spike in Chinese cases, the total number of reported cases in China for the entirety of the pandemic is about a third of the cases reported for just 1 day in the United States back in January. I saw a headline at the gym the other day that President Xi remains committed to strict COVID protocols. But I have to believe at some point the Chinese citizens are going to say they've had enough, especially if they're seeing videos like the ones you talked about, Joe. But for the time being, strict lockdowns will adversely affect the Chinese economy. Besides COVID, there are other factors such as stress in the property sector and increased regulations that are also having an impact. All that said, we and our asset managers continue to view China through a long-term lens. We simply cannot ignore China. It's the largest country in terms of population. It's the world's second largest economy and will likely surpass the US in a generation. We believe that rapid urbanization, China's commitment to its Belt Road Initiative, and increased wealth creation among the Chinese population will ultimately reward patient investors. We and our asset managers remain committed to our investments in China.
Great. Thanks, Dave. This is a great discussion in a complex and changing investment landscape.